These two candles are by far my favorite way to identify daily bias. But first, the receipts. $11,883, a payout I received on the 3rd of June. Then $4,324, a payout I received via Rise following that. Then $2,330 on the 12th of June. Then $3,317 the day after. Then $2,872 on the 17th, $5,830 on the 26th, and $7,115 the following day, coming to a grand total of $37,621. Now, with that out the way, essentially, when we're trying to identify the daily bias, our main job is to predict what the next daily candle will look like. Would it be an up candle or a down candle? And this is where the engulfing bar play excels. The best part is that there are just two rules to follow here. Rule number one, take out the prior candle's high. Then rule number two, close below the prior candle's opening, making the engulfing bar play the simplest way to identify daily bias. But why these two specific rules? Because see, when we take out the prior candle's high, we're taking out the liquidity above it, knocking out whoever stop was placed there in the process. And then when we close below the prior candle's opening, we gain momentum. That follows through on the next candle, identifying the bias for it. This works both ways, bearish and bullish. But now I want you to listen more closely. Because while we've identified what the daily bias is, it's no good to us if we cannot capitalize on it. So to do that, apply a Fibonacci on the engulfing bar with the levels 0.25, 0.5, and 0.75. Why? Because this will get you what I like to call guardrails. These are basically key levels that will provide resistance once price gets there. And since they are key levels, you can anticipate high probability setups to form around them, which will allow you to capitalize on the daily bias. But enough said, let's go over some real charts so you can understand how to exactly use the engulfing bar play to start catching moves that'll retire your 9 to 5.
This right here is NASDAQ on the weekly time frame. I'm choosing this particular example because while the engulfing bar play works, this was one of those times where you had to build a narrative around it to understand the full picture. If you guys have been following me for any length of time, you know that everything I do requires narrative. Now, what is the narrative that was identified in this scenario? We were essentially trading in a range from this high in here down to this swing low. So this is our dealing range from swing high to swing low. It's both evident when we look at this weekly chart and when we understand how a range, more specifically a dealing range, is formed in the first place. It essentially takes out liquidity from the upside in here. So we take out one area of liquidity and then we take out the opposing end of the range as well. Now, having been through a detailed walkthrough of the engulfing bar play in the beginning, I want you to challenge yourself by trying to identify an engulfing bar that's right in front of us. So I'll go ahead and give you guys a few seconds. Now remember, it's these two candles right in here. And since we're bullish, we first take out the prior candle's low in here. And then we have a closure above the candle's opening price, as shown in this example. Now, the key to trade the engulfing bar play for extreme profitability and being able to utilize this system to help you out of your 9 to 5 job or to help you with extra income that can come in from trading, it's imperative that we go ahead and combine it with other concepts like what we did with the dealing range. Now, in this example, we see something else, and here we also see a bullish fair value gap. So the market is essentially forming this engulfing bar at a discount level. We also have this swing low to this swing high, and the market is essentially inside of a bullish impulse as well. This gives us further confirmation. Now, once we see the engulfing bar, what do? We essentially draw the fib from swing low to swing high of this bar in here. And we essentially put our settings where it's a 0.25, 0.5, and the 0.75 as shown in this example. Now, why do we do this? This essentially identifies the engulfing bar's range. And now what we're looking for is the basic concept of power of three, where we have the next candle opening. We want to see a drop lower into one of these levels. And then we want to see an expansion move higher into the candle's high, as well as the bullish narrative, which in this example, we have this overall swing, we have this swing high that's formed. And what we're looking for again is this basic idea that the market is going to open up, we're going to have a move lower, and then we're going to have an expansion move higher. Now again, I really want us to identify this high because this high is essentially our higher high point of this overall swing. So as we know with basic market structure, swing low, swing high, the market forms a potential higher low. Some people call this internal range to external range liquidity. But again, if you guys know how I trade, I primarily use structure. So essentially the market is forming a potential higher low. And if this is going to be a higher low point, it needs to fulfill this higher high, which is a monthly high objective. So we have this delineated on the chart. And now this gives us a bullish narrative. The beautiful thing about the engulfing bar is it gives us the confirmation that the market is ready to head higher. So if we identify our bullish narrative, where the market is essentially reacting off of a bullish fair value gap, we have bullish structure, we have this monthly high, we can then anticipate the market to the next weekly candle to potentially open, have some sort of move lower to form a bottom wick like this, and then we have a strong expansion move and potentially close as a long, wide range bullish candle. Now, a caveat to this as well is typically inside of a dealing range, if you see a consolidation at the 50% mark, as we have in here, typically the market will have come out of some sort of expansion into an expansion move out of this consolidation. Remember, consolidation leads to expansion. And when we see consolidation at the dealing range, 50%, and we see an engulfing bar candle like this, which gives us a potential bullish confirmation, this gives us the indication that now the market is potentially ready to break out of this consolidation. So let's go ahead and let's look into the daily chart and let's start to do our top-down analysis on this example. Now, on this daily example, we're going to just focus primarily on the daily time frame and essentially this overall swing. Now, so the only thing that we need to have marked out is essentially this. We have our monthly high that's marked out, right? So that's our objective on the higher time frame. We also have the area on the fib that we're essentially looking for. So we're looking for the price to essentially have a move lower. And we do have this fair value gap that's essentially formed. Again, just so we know that this swing essentially formed inside of a higher time frame discount level. Now, I want us to look a little bit deeper into this. Just for a quick second, I'm just going to go ahead and remove the wicks. Now, the reason being is because we know when it comes to liquidity is typically arising at specific key points. We have essentially equal highs are here that are essentially shown with the bodies of the candle. Remember, as ICT has said it before, wicks do the damage, but bodies tell the story. And in this example, we have relative equal highs that are resting with these bodies of the candle. Now, one thing, if you trade rejection blocks, as I'm going to show you guys in the prior slides, rejection blocks essentially does the same. And if you guys have been following my content for any long amount of time, I usually like to take profits at the rejection block because of this concept. Because again, if we remove the wicks, we're going to see that there's relative equal highs that's resting. So this gives us an indication that the market has a low resistance liquidity run signature, meaning that there's a lot of liquidity resting, especially because this is daily time frame, where a lot of big orders are resting in here. These are the bulk of the volume when it comes to liquidity, because big funds and institutions typically will put their orders around these areas, around the bodies of the candles. Now look at this perspective. Imagine someone was short in here or short in there, and we start to see a rally higher. The key metric in this is that a lot of people who are going short on even on the daily candles with big orders like the institutions who trade daily bars and weekly bars are essentially going to have a big pool of orders resting above these highs, which gives us an edge because we understand that there's going to be a potential squeeze to take out these stops. Now let's go back into identifying our daily range. The big thing that I always get questions on is which one of these three are going to be the typical driver for price, right? Is it going to be the 0.25? Is it going to be the 0.5? Or is it going to be the 0.75? And the truth of the matter is this, it's neither. Now let me explain. What you want to do is you want to identify the narrative and you want to identify key levels at these specific points. So we obviously see this clear bullish fair value gap that's present here around the 0.25. What do we also see? We essentially have a breaker where this market has a push up, the market has a drop to take out this liquidity pool, and we have an impulse push up. So this fair value gap is also in alignment with this prior structural high. So we now have a key area where the market may go ahead and trade down into and look for us for a potential trade. So with that understanding, what I typically would do is I'll just focus on that area, because sometimes people will look for a deeper retracement, but that deeper retracement is not always there because we have a clear discount level that's present in here. Also at the 0.5, we don't necessarily see any key level, right? We already have a wick here. The market has efficiently traded. And now this is essentially our area of inefficiency. So what we can do is just focus on that key level, and we could remove the 0.5 and the 0.75, and we'll just focus on this key level. And now this is where the magic happens, where we look for intraday trades to occur inside of this area. So my favorite time frame to go down into is the 1 hour time frame. Now here on the 1 hour time frame, what we can see is the price, how it reacts to the 0.25. Now, just for argument's sake, I personally do not like to trade Mondays because, as we can see here, typically Monday will have some sort of consolidation and it could be a little bit choppy. In this example, you could have made it work because, again, it hit our key levels and hit that fair value gap and the 0.25 area inside of Monday's range. But again, I like to just avoid Monday just because of the consolidation. So again, we have our narrative in place from the daily time frame. And what we want to see is what happens going into Tuesday. The key thing that I mapped out for you guys here is I already mapped out the key time windows. Anyone who's following me for any length of time, you know I like to trade liquidity, structure, and time. So when I have these elements in price together, this is where I love to have a bunch of different confluences. So I mapped out the key time windows I'm typically looking for in price, specifically AM and PM session, which is also the time windows for NASDAQ. Now, what do we see here in Asia? We see a price sweep of liquidity, followed by a push up, and the market has a push up during the London session. But you guys are going to see where I personally like to enter, where during London Open, we could see a sweep of liquidity on this candle right here, and then the market has a big wide range candle higher. This to me is indicative of displacement, which is very critical for me to look for impulse legs. Now I'm going to map out that order block, and this would be a typical entry that I would like to take, where we have our narrative, we have the monthly high that we're looking to target. We also have those relative equal highs that we're resting in terms of the rejection block. So what am I looking for is a move back into the order block for a potential entry, especially because this down close move took out liquidity before a push up, and this wide range candle again gives us the idea of displacement. So now all we have to do is just place an order at the order block. If you're someone who just wants to draw a fib and get in like around 50% or OTE, that's also a viable option. And my stop loss will always go a little bit below the swing low, and my objective in this example would be the monthly high. So right here we get our fill, and look at how we get the fill right inside of the AM session. And then price eventually has that expansion move higher, and we start to make new highs in here. And this is where we could do one of two things. When it comes to trade management, it's really up to the individual. Do you want to take partials as price makes new highs? Do you want to hold the full position to the monthly high? Or do you want to trail the stop loss? But in this type of situation, for me personally, when I see the market making new highs, I am looking to put my stop loss to break even. So in this situation, I'm going to put my stop loss to break even. And now I'm going to identify the swing. This is why I like the hourly time frame, because there's a lot less noise on this time frame. So now we have this big down close candle before the move up. So I'm going to delineate this order block, and look how it also has a fair value gap component to it. So now I really want to make sure that if I'm going to hold this trade, I'm at break even. And now I just want to make sure that this order block holds in price. Now, if you guys are in the academy, you already know that, there's a potential for a dynamic risk entry here where you can add to your positions as long as your higher time frame objective is still relatively far away. And look at this beautiful, beautiful reaction where the market comes into this order block, fair value gap, and we start to see price have a push up. And look at how the price respects on this specific candle. This was around during the London Open as well, and we start to see an expansion move higher. And look at that reaction at the monthly high, target hit, and a beautiful example of how we can use the engulfing bar play with a narrative and the lower time frames in order to frame trade setups. Now, this was also a really good indication on top-down analysis, but if you guys enjoyed this video, make sure to let me know what you guys would like to see next, and if you would like to show more examples on this type of style of trading, where I use engulfing bars as well as structure, liquidity, and time windows to piece together a trading setup. If you guys are new to the channel, make sure to subscribe and make sure to join the public Telegram. It's 100% free. I talk about these types of concepts and I give you guys my weekly trade analysis inside the Telegram. So until next time, I'll see you guys in the next video.